So I talked about the T accounts regarding the accounting equation, assets equals liabilities plus owner's equity. So basically I've shown you how to prepare T accounts for these accounts, but I haven't shown you how these accounts are affected using T accounts. So to do that, and to make it easier, remember I said think about how, when you are putting your numbers in these accounts, think about how they affect the capital or owner's equity. So let's take a look, and I want you to make a big T now. And don't forget that on the capital account, which is an owner's equity account, it does decrease on the debit side and it increases on the credit side. So thinking about investments, thinking about revenues, expenses, and the drawing account. So think of the capital, think investments, increase the capital, and therefore we're just going to, actually I'm going to move this down. Anytime the owner invests money, you're going to put that right into the capital. Otherwise, you're going to use these temporary T accounts for revenue, expenses, and withdrawals. Since we know that investments increase the capital and revenue increases the capital, we're going to put investments and revenue on the credit side. So go ahead and identify this T account as your revenue accounts. And those are going to decrease on the debit and increase on the credit side. Now, expenses in the drawing account will decrease the capital, and I want you to think of this big T. We've got three little T's, but this big T, that's what I want you to think about. Revenue increases the capital, expenses decrease the capital, and the withdrawals or the drawing account decreases. So if they decrease, these are going to be the little t's, the temporary accounts for your expenses and your drawing account. And this is the hardest part to understand. We need to keep a running total and a positive total. So if you spent $1,000 this month on rent and another $1,000 on rent, that means you've spent $2,000. So expenses are going to increase on the debit and then decrease on the credit. And the best way to think about this is, in the end, debits, you'll have a running total over here, debits decrease the capital. Therefore, expenses are going to increase on the debit side. And then the same thing for the drawing account. Since the drawing takes away from the capital, the drawing account will increase on the debit side. So if the owner withdrew money, you would debit the drawing account, which in the big picture will actually decrease the capital.